Welcome back to smarthelping.com. I've got a software as a service financial model 5-year plan, and this is different from any other SaaS model I've done. I've done quite a few of them. This is completely driven by ratios, and I'll get into what that means, but it's definitely a new way of building a model from the other types I've done, and it's focused more on performance of account executives. So I'll get into each tab, what it is, how it relates to everything, and explain the model to you. So first tab, control, is where you're going to define the start year. You always enter the first day of the year of the forecast. So if you're going to start in 2020 or 2021, whatever year, this is always the first day of that year because the 5-year forecast goes for full 5 years, starting with the first day of that year, even if your revenue starts later. Um, this allows you for better timing assumptions. Then you'll have your exit month, which is any month within the 5-year period, or you can put NA if you don't want to have an exit value in the model, which is completely fine. I would note all of these are just assumptions. The model is designed for you to use for your specific situations. I've just built all the logic so it can assert those things based on what you think is going to fit your specific situation. Next up is debt proceeds. So this is going to flow into our debt amortization schedule. You can put the terms in on the debt schedule, pick the month that you plan on that happening, and then the amount is actually going to pull right from the control tab. That all flows into this all flows into the monthly and annual summaries, which then flows to the uh, cash flow, and that populates distributions and executive summary. Investor equity. So this is if you're going to raise money from outside parties, and you're going to give them some share of the profits based on their contribution amount, and this is just an applied valuation based on those two things. Obviously, these will be different for every single deal. The final number is basically the cash that these two things don't cover. Now, it's not something like if you raise enough money and you don't want to have, as the owner, you don't want to put in any money, um, you don't have to. This will just allow you, this will tell you, let's say, like we raised $5 million. As you see, this goes to zero, but you're still giving the owners a share and the investors a share. So this just defaults into a number if there's any other cash that's needed, and this is based on your startup costs, your running, if there's any net negative burn, and all of that. Um, this would the amount of cash needed would pop into here if it's not covered by any debt proceeds and investor funding. And you can see the debt and equity breakdown based on that. Next is the headcount. So this is the most important part of the model, the most interesting, and this is something new. I haven't done it in any other model. So we start with sales directors, and you can pick the starting amount of sales directors. It could be 1, 5, whatever, and this could be, possibly if your company's 2 or 3 or 4 years old and you have some starting assumptions out of the gate, then this would allow for that. But we're just going to put 1 in here for starting. And then what we're going to do is this allows you to say how many sales directors you're going to add per month in each year. So this theoretically says you're going to order, or not order, you're going to try to hire a half of a sales director every month. Now, why is it a half? Well, that just means you're basically every 2 months, you're going to hire 1 sales director. And decimals is fine in this forecasting model. It actually allows you to do better assumptions and more accurate um, to fit what you planned. So decimals here works completely fine. Um, so we've got sales directors being hired, and then what we're gonna do is this is the first big ratio. So this is gonna say how many account executives do you want per sales director. So based on this hiring plan, you're going to have sales directors being hired. Based on the actual number of sales directors that currently exist, and this ratio is going to define how many account executives you will have. And you can go, there's a lot of studies that are done on this, but typically as revenues go up and companies get larger, the amount of account executives goes up in relation to the amount of sales directors. So I've done that here, but obviously this could go down if you want it to. It could stay the same. It doesn't matter. It's just the logic will work however you want to make it work. Right now, I've just got it going up to finally in year 5. For every one sales director, there's 3 account executives. Now, why are the account executives so important? In this model, they're important because you're defining how many new deals happen each month per account executive. And we're doing that with this next assumption, which is a deal quota. So this is saying every sales director has a quota of 4 deals per month. And this could be obviously whatever your quota is. It's going to depend on the business, but I've just put 4 in here. And then it's not going to automatically say every single account executive is able to attain this quota every month. It's a slow buildup. So what I've done here, and you could adjust the months over here as you see fit for your forecast, but this is going to say of the percentage of the quota that an account executive can get in their first 1 to 3 months, 4 to 6, 7 to 9, 10 to 12, and then after that. So this is saying it actually takes, in this scenario, a full year until your account executive is able to do 4 deals a month. And before that, like in their first 3 months, they're only going to be able to do 10% of that. And again, decimals are fine, even with the deals. It just is a good way to show granular and smooth growth over time. So it's okay that it's not whole numbers. It's still the purpose is are served, and you can see over time what to expect on a kind of a fractional basis if it's not a whole number. So this logic was pretty complex. I've done it one other time in a kind of a marketing services firm where you have excuse me, where you have like an account executive that's trying to sell advertising space or sell X amount of deals per period, and that's different though because in that it's just one-time fees. In this, your account executives are signing up people who are going to pay a recurring monthly fee over time, and then there's some churn rate that we're going to do, but that dynamic I've never modeled before, and I've worked on a lot of these, and this is one of the main ways that you can do a SaaS model that I have not really done a template for. So I think that's why I think it's a good one to have here. So your account executives have built up to them being performing, and that buildup really shows you a better idea of your burn for hiring account executives when they're not. If you hire like a whole bunch of account executives right off the bat, it doesn't automatically mean you're going to make a ton of deals right off the bat because all those account executives need to get trained, and there's a learning curve, and it takes them time most likely to get to their full potential, and whatever their full potential is planned to be based on this quota number here. So it really gives you a more accurate picture of the cash flow than if you assumed they were 100%, efficient right off the bat. And I think this is a really, really nice model to show that. So we've got the headcounts, we got account executives based on the amount of sales directors. Then we have the salaries. So we obviously need to know what the salaries are for sales directors over time. Right now I've just put $65,000, and this is actually a per year per sales director figure. Here's the one for account executives, and here's one for customer service reps. And so you could fill in there what makes sense for your situation. Customer service reps will also get into what is going to drive well, we're going to get into it right now, actually. Um, so once you've done the salaries for those 3 types of employees, we have customer service reps, and what we're going to use to define the ratio or to define the customer service rep count is give a ratio of how many reps you need per new signups per month plus how many you need for ongoing active users. So this is saying, like here we put 20 for year one, so that means for every 20 new subscribers, you're going to need one rep, plus for every 50 active users, you're going to need one rep. And we're going to add those two together to get a final count of customer service reps that are needed. Now you can change those ratios over time, so you can see this has got it going higher, meaning you need less customer service reps to handle more growth, which is being efficiency. If this does go up, this can go down. It can stay flat. You can have it go however which way you want, and it will affect the model accordingly. Uh, so there's customer service reps. Engineers we're also doing as a ratio, and the ratio is a defined percentage of the total revenue that you want to budget for engineers. So you can define that percentage here, and then based on the salaries, the annual salaries of engineers, which can also change over time if needed, the logic is going to divide the revenues budgeted for engineers by this to give you a count of engineers. So that's another interesting piece of logic I've never done. I thought it was pretty good, and it allows you to from a high level, control how much you're going to spend on engineering, and that's usually a big cost for software as a service companies because um, you've got to develop the software, and the engineering is a huge part of that. And then I have done two types of engineers. So you've got like a type 1 with a bigger salary, type 2 with a lower, and then you can define out of the total engineers what percent are going to be type 1 and type 2. Okay, so you can see I'll first go to the matrix. So this is what I've had to do to get this to work right. So this kind of defines the amount of new account executive hires that happen in every month. So this represents month 1, month 2, and it's simply just based on the amount of AEs added, which is going to run off of our monthly detail, which is this runs off. You can see this is doing a lookup on the headcounts and running off of the amount of sales directors. So based on the amount of sales directors, we know there has to be X amount of AEs. And then we know based on the difference of one month to the other, we know how many are hired. So you can see we hire one here, we go to one, then we hire a second one. So now we've hired two total, one each month. We now have none added here. We have one more added here, so we're hiring another. So that's how that works. So we know the key is we need to know how many new AEs are joining each month in order to know their efficiencies and what months they're on for their quota matching stuff. So the first matrix shows you just one number, which is the amount of AEs that are hired in that month. The next matrix will show you how many months they've been active. So you can see these numbers only start as soon as there is a hire here, or a number that's greater than 0. So over time, these come on, and it just starts counting into perpetuity. So then we can do a calculation to figure out how many deals are done for that monthly cohort of AEs added. So, and it's going to be simply do the month that it's been active is going to define the percent that they've met their quota, or how close their quota they've gotten. So that's going to be based on how many months they've been active, times the actual amount of AEs that were hired in that month, times times the actual deal quota, and that number will get us the amount of expected deals to happen for all the AEs that were hired in month 1, month 2, month 3, and so on. And you can see if we go to a month where there were a lot of AEs hired, let's see if we have one. Well, here's one for 3. So month 25 should have fairly high quota. Yeah. Oh wait, month 25. So 1.2, and then when they're meeting their full quota, it's 12 because you've got 3 there, and their quota is 4 per month. So 4 times 3 is 12, so 12 deals a month is their max that those 3 are planned to do. Now, you can see if I change this to 5, how this changes the matrix. You can see now it's 15. So now their max is 15 a month for those 3. Here's one that's 20, month 13. How many do we hire in month 13? Ah, 4. Yeah, so that was higher than 25. So that's how the logic works. It's all dynamic. It's all really nice. Works perfectly, and I think that's a really useful way to forecast revenues based on headcounts of your sales directors and account executives. All right, so there's your main ratios. The next part is revenue, which is we've done 3 pricing tiers for the SaaS. You just determine their monthly pricing per year. So this is saying in year 1, 400 basic tier is $400 a month, then 440, 484, and obviously these could be whatever you plan on your numbers being. Standard premium, you can determine if you've already got subscribers in each level, you can put that here, and that will automatically flow to the model accordingly. Uh, Next is, well, we have to determine of the new deals how many end up being basic, standard, or premium. So you could do that with percentages here and change that over time. You've also got the monthly churn of each tier. I've just put them all the same for now, but you can change those. Uh, and then we got one-time setup fees, and this could be 0 if there are no setup fees. But typically in this type of a business uh, model, when you're relying mainly on your account executives to close deals, these are typically bigger deals, a higher ticket price per month, and usually there's some kind of setup fee with that. But yeah, it just depends on your situation. You can zero out anything that doesn't apply to your uh, what you're doing specifically, and that would be fine. So those are revenue assumptions. Now we got fixed expenses. Now this is pretty straightforward. It's just I've tried to list all the main. Now these top 12 are all in order to get a proper head count. These are all salaried positions. So your executives, some general managers like head of marketing, finance, and then I've allowed an extra 4 slots for anything you want. So these can't really. You could change the description of these to whatever you want. It won't matter, but they should either be zeroed out if you don't have a salaried position here, or else it should be a salaried position. You can pick the month that they start, so that's nice, gives you some dynamic functionality there, and then you simply pick their monthly salary, all-in salary, and you can change that per year if you want. It just depends again on how you want to, what your plan is. Then we've got some other just general and administrative expenses. I've put 9 extra slots here. Get to start month and pick the monthly amount in each year. We've got some general sales and marketing spend. It works the same way. Pick the month, pick the amount per year, the monthly amount, and you can change that per year. Uh, Cost of goods sold, I just did 2. One is cost per user per month, which is this one. Um, and then one is directly a percent of revenue. So you might have one or the other or both of these, and based on that, whatever it is for your situation, you can populate your cost of goods sold based on that. Typically, it's always either based on revenue or the count of users. So that's how we've done cost of goods sold, and that's going to pull through. And I'll go over all this in a minute. So that'll pull through here. You can see it takes the consolidated total users ending for the month times whatever that number is per month. Same in the percentages is the same thing, but for revenue, based on total revenue. Okay, next we've got R&D. So these are extra R&D slots on top of um, your engineers. So anything else that you might consider R&D, you could pick the month it starts and the amount of that. That'll flow to R&D. Then we got possibilities for credit card payments. So you just pick the total of your total revenue, how much is going to be paid with credit cards, and then what's the credit card fee. That's planned to go down because you obviously don't want to pay credit card fees over time. So you hopefully get people on payment plans that where you don't have to pay a fee. Then we've got some other general G&A costs per employee. This is another new one I haven't done before, but you can determine based on your total head count what's your monthly cost for different things. So I just put, coffee, food, whatever. You can put whatever you want in here that makes sense, and that'll pull through for G&A, another G&A expense. I've also tried to list here descriptions of each type of expense to just further clarify. Next up, we've got CapEx. So this is if you're gonna maybe you're gonna buy the office building instead of rent. You'd put that in here. Build a website. That's often typical with the SaaS. You might have an office with you might need furniture, kiosk, computers, equipment, anything that you have to spend right off the bat before you can even start would go in here. And then CapEx is almost the same thing, but you're just going to do it in some month in the future. So it could be like expansion, upgrade to the equipment, whatever it might be, that's going to flow here, and that'll be a cash outflow item on our monthly summaries. So that's all the assumptions. Based on that, the monthly summary will populate. So this shows you your head counts for AEs, SDRs. We know how many total new users are coming on based on our matrix here, which is just summing up. We went over how this worked, but it's just summing up each month's cohort's AEs, how much they should be getting based on their performance. And then based on the percentage we defined that go to each tier, we can figure out how many users are added, what's the starting user count, how many users are lost, and then what's the end user count for each tier. And that you can see that build up over time. We've also got the recurring revenue of each tier, so that's just taking these numbers and multiplying it by the pricing that you've defined in your revenue assumptions at the top. So this is your monthly recurring revenue at the end of each month. You can see how much you started with, how much you gained, how much you lost, and for each tier. Then I've consolidated all the user and revenues into their own sections for the aggregation of basic, standard, and premium tiers. So that's cool. Nice way to see in detail and in the aggregate. We also have that one-time pricing if applicable, which flows here. And then based on all of that, you can then calculate your total revenue, which is just your one-time revenue plus all your recurring revenues. And then I put headcounts right below that so you can kind of see what your monthly revenue is per employee in general. We'll actually do a calculation down at the bottom that has here. It has revenue per employee per month. Also, I've done it per year on the annual tab. That can often be a comparative metric. Cost of goods sold, gross profit. This is how we calculate our engineering budgets and the engineer counts. Keep going. Operating expenses. So this is pulling rate from the fixed expenses. And based on the month started, it's going to populate through time. all the way down. Here's all the different types we had listed. Then we can get to EBITDA because we've got our total operating revenues less our total operating expenses. And also put in your EBITDA margin. You've got debt service, debt service coverage ratio, which is just your EBITDA relative to the debt service. Then we've got debt proceeds, so this is all dynamic as well, but your funding from debt will come in here. If you exit and choose an exit value, it'll assume that you're going to have to pay back the debt. If there's an NA for the exit, then it will not come out of the cash flow. Then we've got an exit value based on a revenue multiple, which I'm just taking the monthly revenue annualized and then times the multiple put in the control tab. So that's what this is right here. So you can put like 1.5x revenues. We'll give you 64 million, which is saying, you see right there, it's taking your control, the ratio times the monthly amount times 12, so it's annualizing that revenue rate. There it is. So 3.5 times 12 times the multiple. Then we got CapEx, so these one-time expenses. Startup costs are here. Then we can finally get to a cash flow. This is basically including everything besides the final equity from the owner if needed. And then you'll see here, this is our final actual cash position, which in this model, since we solve for the min cash position of equity, this will always go to 0. You see right here, it happens in month 24. So it will never be negative because it defaults into the equity needed so that it's not negative. So this cash flow part's pretty complex. I haven't included anything with taxes here because I'm trying to reduce complexity and just get the most important things that are material in such a forecast. So we haven't done anything with taxes. I just got down the cash flow after all the other items. And based on what this monthly cash in and out is, if it's negative or positive, it'll populate the distributions and contributions, and then that'll net against the actual initial equity contributions to get a final distribution schedule here for the project, and then it's broken down between investors and owners as well. So the logic I've done here is really unique. I've never seen it, but it's super concise. It handles all kinds of different scenarios where you've got burn out into the future and possible big cash outlays that happen after you're operating. And so it can tell you what the cash flows look like and if there's going to be more equity requirements down the road or not, and who goes to what and how much is distributed to investors versus your owners, everything like that. And this took a very years to perfect to make this kind of go how I needed it. So super helpful. And then we've got discounted cash flow on these distributions as well, and the net present value, which is just taking based on the discount rate, the present value of the cash flows in the future against the actual initial investment. And then we've also got an internal rate of return here for the project, for the investor, and for the owner. And in the executive summary, you can see some more multiples of those, as well as I think, what did I do? Investor ROI, equity multiple, total cash return, equity invested, and IRR. Okay, so where were we? Then I did advanced metrics, so customer acquisition cost, average recurring revenue per user, one-time revenue per user, customer lifetime value, months to paybacks, customer acquisition cost, and your lifetime value to customer acquisition cost ratio, revenue per employee, and then the final cash position, we already went over that. So this has got everything you would need for this kind of a model. All the advanced metrics. It's got ratio driven growth, which I think is really a good way to do this. Um, it depends on what your actual type of SaaS company is, how it runs, but this is one that would be more dependent on your account executives to close deals. And the annual tab just shows the same exact thing as the monthly, but just on an annual basis. And you always want to make sure those tie out, like the cash flow here. If we the cash position 99,586,990 should always be the same as the monthly. You see it is. That should match up with the executive summary cash flow, which it does. And that should also match the net distributions up here, 99,586,990, which it does. This is basically saying how much cash is generated um, after you account for the equity being paid back, essentially. Uh, Executive summary just shows the high level stuff. So your main revenue items, your cost of goods sold, G&A, sales and marketing, R&D, and a percentage of revenues for each of those. You can see that at sales and marketing, because of the scale of the account executives and sales directors, you're actually higher than revenue in year one. That's why there's a bit of a loss in year one, and that's your effect of trying to scale up quickly. And you got to pay those account executive salaries, and it takes a bit for them to actually build up a user base for you. So it's nice to see how that effect happen, and based on your assumptions, you'll see how fast or not fast you start making money based on your assumptions. Debt service coverage ratio, all the cash items we went through. And so that's pretty much it. The only thing I haven't shown you is the visuals. So we've done a lot of visuals here. I've got annual revenue by type, annual revenue by type stacked. So this is basically, you can see your total revenue at the top of the bar, and then it shows you of that total how much is made up of each type of revenue. Those would change if you change the assumptions. Revenue, gross profit, EBITDA, cash flow. So these are the main cash inflow items and net items. You can see the exit value is going to make that one bigger. Revenue and expenses. So this is showing you each year what are you making in revenue, and then all the little smaller ones are your expenses relative to that, your main operating expenses. Headcount by type. So we've done the actual count. So this is showing you your total count as a stack number. So it's 140, but each individual type of employee is listed. So you've got 37 engineers, 12 engineers type 1, 43 customer service reps, 38 account executives, and then you've got 12.5 sales directors. So this is not including your executive headcounts, those 12 slots that I mentioned. And the reason why is because those don't really change over time. I mean, yes, you can change the month they start, but they're not really ratio driven like these are. So I've only shown the ratio driven headcounts here. And this shows the same thing, headcount by type, but a percentage of the total. So you can see over time, we start with mainly sales directors and account executives, but as revenue grows, more money starts to go into engineering and customer service, and as a percentage of the total, that becomes more, and sales director and AE becomes less. But they're all growing over time. You can see by this chart, you can see how much they're becoming over time. Then we've got the actual headcount numbers by type, and I've split the SDR and AEs separately in these charts. So this is only those two types, and this is actually showing the total. Each line is the total amount that type of employee, the count of them over time. And then this is the same chart, but showing a percentage of total for each. So this is obviously we made. This is pretty cool. Watch this. So here we've made AEs become a greater there's more AEs relative to sales directors. Watch if we change this to, let's say, 1. Let's say we keep it at 1.5 and don't grow it any higher. Watch how this chart changes. So there you can see it's more evened out. And that actually changes all of these things change because of that, because everything's tied to account executives and how many deals they get. And then revenue is tied to the amount of engineers, customer service is dependent on the amount of deals coming through. So it's all tied together, nice and neat. I'll put that back to how it was. All right, so now cumulative users. So this is just showing you your total users is going to be at the top. You see 2,500 here, and then this shows you of the 2,500 how many are premium users, standard, basic. Oh wait, I think I skipped one. Yeah, I skipped these two. This was actually the cumulative users by type, uh, and that is showing individually how many there are. So it's saying you've got, 1,100 premium users at the end, 700 standard, 480 basic, and then this shows the percentage each as a total, and this graph is going to mimic your ratio here of the percentage. Like let's say at the end we put it back to like 90 and 5 and 5. This chart is going to change a lot. So yeah, you can see the basic users start to go up in the last year, um, because we're saying in that assumption now that 90% of users go to basic. And put it back. And then we just went over the cumulative users by type, stack chart. Then we've got the recurring revenue you're getting for each of the different user types over time. And then the same thing, but recurring revenue of each user by type stacked. Then we got gross profit margins, your monthly cash position. Then this is contribution distributions for equity. So this is your cash initial investment and the returns on that investment over time. Then we got our advanced metrics, so customer acquisition cost, average monthly revenue per user, months of payback CAC, average customer lifetime value, your lifetime value to CAC ratio, and then annual revenue per employee. And you can see this dips down. The reason why this dips down is because in the last year we really ramp up the amount of account executives we want per sales director. So even though we've actually not added any new sales directors in the last 3 years, we want to start adding more account executives. So that extra hiring, it's going to have, those salaries are going to be a burn, and it takes time for those account executives to actually start performing. So that's why the lifetime value is actually going down, is starting to cost more to acquire these customers relative to the lifetime value, but then you see the slowly build up here. And then annual revenue per employee we got in each year. All right, so that's everything. And if you want to buy this template, I'm selling it at smarthelping.com. I'll also have it on my partner channels on Eloquent and efinancialmodels.com. So it'll be $125 one-time fee. I will have it here at smarthelping.com right at the top. It'll be in the financial models tab under, I'll probably put it under general business models and tools because it's not really industry specific. It could be for all kinds of industries. And then I'm going to also add this to the as a service bundle without raising the bundle price. So you'll get, the initial standard SaaS. I did a product as a service, security alarm. Now the security alarm was interesting because on that one I included negative churn and moving from tier 1, 2 to 3 and up and down on that, and calculated revenue expansion. So that's got a lot of advanced metrics in it. The mobile app driven one, freemium, lending as a service, a payback planner, a marketplace model, and then the standard 3-statement financial model. So I'm actually going to add this ratio driven SaaS model to this bundle, um, and I will not raise the actual bundle price here to $289. So I think that's a great deal. If you do want to buy it on its own, it's going to be $125. And as soon as you do buy it, I always manually send the templates, but you should be directed to a link when you when you pay. It's just sometimes if you don't have a PayPal account, it might not show you the link. So I just always manually send them anyway every time a sale comes through. So I will guarantee that gets to you usually 5 to 10 minutes after purchase at the latest, unless I'm sleeping or doing something else um, and can't do it. But typically, I don't have any issues getting those out really with a high turnaround. Okay, well that's all I got for you. I hope you guys enjoy. I'll see you on the next one. This is smarthelping.com.